Hey, welcome to the New Home Insights podcast by John Burns Real Estate Consulting. I'm Dean Worley, your host. Each episode, we're going to bring you some of the best minds in the housing business talking about some fascinating topics or trend or innovation or issue, just like the one you're about to listen to. Enjoy. Welcome to New Home Insights, the John Burns Real Estate podcast about the U.S. housing market. I'm your host, Dean Worley. Today, we have a very special treat for you. It's Melissa Abel, the Executive Vice President at Texas Capital Bank. She oversees their builder finance arm. She's been working her magic since 2010 there, I think going nationwide in 2012. She'll correct me if I'm wrong. And we're talking big dollars here, by the way, as in a portfolio of over $1 billion because everything is bigger in Texas, as we all know. Melissa, welcome to the show. Why don't you start us off by give us a little bit about yourself and about Texas Capital Bank?
Sure. Thank you very much. I appreciate the opportunity to get to speak with you guys. So as it relates to me, I am, I guess, on my 22nd year specifically in the space on the finance side. And I guess last year I turned legal at 21. So in many of the clients, we've continued to finance during that entire period in the group we have together today. I guess depending on who it is, been together over 17 years. So great spot to be. That's for sure. You know, I don't know about the 08 through 10 and on that period was a little challenging. However, you know, we were able to take our product, our franchise, and move to Texas Capital to capitalize on where the cycle was to continue to help and fund our partners, our borrowers, be it, you know, our production builders or master plan community developers. So it was fun being a one-trick pony until then. That was for sure. And, you know, kind of back at it, although the distressed asset plays were fun, I think, for all of us. So that is us. Texas Capital is approaching $40 billion in size. We were $7 billion when we started there in early 2010. So we've grown lockstep with them. And actually, on a commitment basis in the space, are running around $3 billion. It's something we're proud of, and we continuously have reinvented ourselves. So between, you know, the entrepreneurial spirit of Texas Capital coming in when they did, and our awesome partners on the client side, and then the depth of experience, you know, we like to think we have something pretty special.
$3 billion to $40 billion
in commitments. Yes.
That's pretty special. What's kind of your main role there for TCB?
Right. We are a nationwide bank, despite the heavy emphasis, which we're proud of, clearly in Texas, being Texas Capital. We have 5 nationwide franchises, of which we're one of them. I oversee, which we call our specialized residential real estate. And it's a neat, and it is unique because it's a through cycle franchise. So we're not just, you know, a shop that does just one side of this industry. We do institutional finance, whereby we lever investment funds and or other lenders in the space. We also do bond anticipation note in the space. We play selectively in the build to rent. And then, of course, you know, our main bread and butter, which we've always relied on, are these long-time relationships with, you know, clients who we consider like ourselves that capitalize through all parts of the cycle.
You started, though, 2010 or so, when conditions in housing were not awesome, let's say. So how and why, I guess, did you decide to get into the housing sector so big?
Like, why am I this crazy? Is that
That's implied, but I wasn't going to say it.
That's implied. No, well, we saw, okay, so we were in the space at RBC, and I mean, our cost of capital was changing, and we can tell, and we know, I mean, I think a differentiator for us is our value is our client base. And, you know, we were worried that the bank RBC was going to continue to be active in this space due to, you know, obviously what was going on around us. But we knew we had a franchise that continued to have builders, developers, clients across the space that continue to profit. And our value is making sure that they have the capital they need. So we actually went out to the market, and at the time, everyone was doing a fund, and it was extremely sexy, and we were leaning that route. And then one night, Jocelyn Ansley and I, probably after one too many glasses of Chardonnay, started backing into the email addresses of the five CEOs of the best banks based in Texas, knowing Texas was getting hit the least, right? If anyone was going to do it. And we would sit there and try the email till it went. So in this case, it was K.Cargill, Keith.Cargill. And finally, our business plan went, and he called, and we sat down, and we knew right away that there was a fit. They were entrepreneurial. They launch lines of business when other banks are running the other way, because that way you're able to get the best clients and retain them. So, the need or the drive came from what we know our value is, which is to continue to finance this awesome group of partners we have in the space.
I'm going to just assume that you're pretty high on the housing sector right now, correct?
Yes, I am correct. I paused. I mean, I do have a few concerns, as I'm sure everyone does, given some of what we've seen. I was a little bit higher about 3 months into COVID when I realized we were going to be, top of this correction and really sail what it felt like through it, comparatively speaking, to the last time. So yes, however, do have concerns on some things that we are seeing.
What's your primary concern right now?
Let me back up with saying
Okay.
the portfolio we have, so we monitor all the clients and we do trend lines on leverage, liquidity, and profitability. It's the healthiest right now today it's ever been. I mean, the average net margin we see is over 9%, leverage at 1.5 times ish, liquidity, robust liquidity of unprecedented amounts. And so it looks really good. However, if you look at, there are less and less land deals that are penciling out that we see. And so, without building an acceleration, it seems like that's getting hot. The lumber prices appear to be a real challenge, and it's odd because it's the first time in history where in a correction, completed specs average 12%, and in a not normal, but in a correction, they're run, sometimes up into the 20s. Right now across our book, our completed spec ratio is less than 4%. Developed lots are at an all-time low. And so we have to feed the beast. And every CEO I talk to, it's a real concern between, this accelerated demand, which, you wonder, is it because people are stuck together and they can't stand it anymore? They get divorced, they each buy a house, or you look around your house, you don't like it, you buy a house. Are we stealing forward demand? And so, and then you say, okay, is it offset by, natural population growth or immigration, especially, on a go forward under the new regime? And so it's just we don't know what we don't know because there has not been one like this. Obviously, interest rates are all-time low, but we have to find a way to get lots on the ground and be able to build houses and do enough, even if we're seeing a lot of, raising prices in the houses without slowing down to the point that, you can't feed the beast. So it's a very interesting time, and I love debating about it because I wish I had someone that knew exactly where we're going to be a year from now that could tell me.
No one does, and no one ever does, even when they think they do. That's my take on projections. But so it sounds like your concerns are both from a little bit from a fundamental, right? Are we stealing from the future? Will renewed immigration kind of offset this push, this extra demand we've had from people from low interest rates and from people seeking to move from the pandemic? But also, you're a little bit. Some of it is just the ability of this sector to keep up with this heightened demand, and that's not a bad problem in most cases, right?
It's not until all of a sudden, you're running out of lot supply, because whether you're buying lots from a third party developer or you develop your own, if you can't make the numbers pencil on buying a piece of land to develop, the only way you can do it is build in acceleration, then you could arguably be getting yourself into a situation that we saw in '08, '07, where people were making land deals work because of building in a huge acceleration that we can't guarantee is going to happen. So I just think it's going to be interesting to watch. One thing I do know, though, we all know the last correction wiped out the vast majority of average operators. The operators we see today are off the charts amazing. And if I trust anybody to figure it out on how to get units on the ground, on how to manage costs, on how to create or continue to deliver these results and capitalize on whatever market we're in, I'm very confident with the operator set, the sophistication the industry has, the types of finance. I mean, whether it's, the bond market, as we all see, is pushing in and a very ugly competitor of ours. And, it's just unforeseen times. But yet, again, if you look at the quality of the leadership we're seeing in these companies, I'd put it against any other industry in the nation.
Yeah. The flavor of your answer here has kind of implied how you're going to answer this next question, but I still want to ask it. How do you make your key decisions about where to invest or who to invest with? Are you are you a numbers person? Are you a relationship person? Do you ever go with your gut?
It's a great question. I would say operator first. I do think it's very entertaining when bankers say, "Oh, I know that, that market," or "I know this project's going to work." And that's not what we're cut out to do, right? So we look to tier one operators that we can trust to navigate through any market and headwind. We want to sleep at night and not try to figure it out ourselves. And so I would say number one is relationship. Tier one operators that no matter what markets they're in, know how to navigate through it. They have discipline. They have strong leadership across the top level, not just one person leading the show. And, of course, having a robust balance sheet and results in history never hurts. We do startups that have the leadership that's made it through corrections, which we like to see because, it's easy to do it when the market's carrying all of us, but where it gets challenging is when it's not. And so, again, really that gut, people that can tell the truth even when it's hard, and we can have meaningful debate. I enjoy debates. That's how I met Mr. Burns when he engaged in a debate with me over dinner. So
You have to tell us that in a second, by the way.
prayerfully enjoy those. And, also there's so many CEOs or CFOs or C-level or even upper management, people on the ground, that we learn from, and we ask every day, how did you make this happen? How did you decide to pull out of this market? Or why did you decide to stop buying land? Or, and I love learning from, the best of the best. And I feel like that's who we finance and we continue to look for.
Do you still get those people who are, blowing smoke and is your smoke detector on for those folks?
My bullshit detector is pretty damn good because I grew up in the horse industry as a kid. And, you've heard plenty of jokes about horse traders. So it's usually pretty spot on. We don't claim to have expertise at the level that our clients do. And so, again, we rely on them. But yeah, of course, there's, people that we have open, honest discussions with and, lying or, trying to avoid the truth. And for us to just put numbers up on the board, that's not our MO. Our MO is we run a business just like our clients do. And we try our very best to make the best decisions, and we're proud of it. We've not incurred losses. We've actually probably missed on opportunities because, we believe, like our clients do, that some of the best deals that you do are the ones you don't do. But on occasion, you're a little conservative and you miss maybe the one you should have done.
Housing is pretty hot right now as a sector, but how much of your interest in housing is because it's relatively healthy versus other asset classes, as opposed to just housing as a really sector you want to be in long term? I mean, do you gauge it against other potential investments on a regular basis?
We do. I mean, again, looking at an operation of the bank size, and there's about 27 different lines of business. We're convicted to a set of metrics that we've agreed to deliver for this bank since day one when we came over and launched back when we did. And as long as we deliver those metrics, which are top of the house and they always have been, it will remain there. But bear in mind, even when everyone was running from housing, we had a portfolio in 2009 of clients that were brilliant operators that were continuing to make money. I mean, housing starts don't go to zero. I mean, in some areas, arguably they damn near dead, but they don't go to flat zero. You just got to make sure you're partnering with the people that are not only capturing the housing starts, but that are geographically diverse to offset, the areas that may be experiencing more pain than others.
So you definitely are big on who your partner is, and you I know you have metrics and look at markets. Do you also within housing? Do you look at different sectors? And I'm going to definitely ask you a question on build for rent in just a minute.
Of course, and that was what I was trying to refer to. Through with this through cycle franchise and the 5 verticals we have, looking at all sides of it. I mean, the one area that, and Burns always makes fun of me, that we don't understand well enough is straight project finance in California. We just don't. In fact, one time I sent Burns a report and I didn't realize that it was a heat map of where we had exposure. And we had cut California off of the map of the United States in an attempt to show more granular exposure. And
That's not okay.
he's like, Melissa, that's a little rough around the edges. I mean,
I
that
mean,
said, we do finance parent level companies that build in California. It's just straight project finance. We just don't know it well enough. And we are believers that, if
okay.
you don't know something, you're going to get yourself hurt.
Melissa, I know you guys have gone into the build for rent sector in a big way. It seems like it's the hottest sector in housing right now. It's certainly one of the stablest. Do you, I mean, can you sort of briefly walk us through the process of underwriting a BFR deal? Or maybe even tell us why you have not or would not do a new BFR deal right now?
Yeah, absolutely. I think history helps. So we financed parent level companies who did the new single family construction, levering off of their single family for sale production product back in, it started in '09. So we've been in this space with 2 marquee clients for quite some time. And it was an ugly word because for the longest time, banks confused it with like the um, older home scattered type approach versus what we're seeing today, the targeted community, so on and so forth. So as we continue to reinvent ourselves over the past 5 years, I mean, obviously we've been at Texas Capital Bank longer, but we knew it was going to cycle. We didn't know how, so we were adding products and verticals, and we added, like I mentioned, the bands, the institutional finance. And then, of course, let's expand build to rent. It's seeming hot. I believe we paid you guys, well, I know we did, to do an in-depth study in the space. It was a great study. I thought the bill was in pesos when I got it, but it was worth it, even though it was in USD, um, to show us. And we were pretty, bullish on the space. But then all of a sudden, we realize a lot of times you can't distinguish in permitting between CRE and build to rent. One, so you can't tell where supply is coming down. Two, we were getting 2 to 3 calls, and this wasn't solicited, a day from, when you see the people who are not in the space that just want to invest. And, got a little concerned because we always want to make sure there's plenty of meat on the bone for everyone who's doing it. We want to make sure there's a proper management company, more than likely internal, but if not external, it makes sense. We want to make sure it's not hey, we're going to put a house on the ground and hopefully it either rents or sells. And, so trying to find the shops that are integrated to the level that we want, that have the capitalization in the event it does get oversupplied, has really been a lot more challenging than we thought. And we could do just one-off projects all day long, easily. And so just trying to really narrow it down to a focus of companies that this is what they do. They know it, they eat it, they sleep it, they breathe it. I think the risk is we've never seen it scaled like this. And so none of us know what we don't know on what could be the downfalls of it. And I think that's the biggest risk. We love it, in the ones that, or at least to our underwriting standards. And, not to say we're right. I mean, and happy to debate it all day long. We could be completely wrong. Definitely wouldn't be my first time. And, trying to figure out what is the right number. Is it, you see an article today, they're one, it's undersupplied, you can't find it, but then we're seeing it, 60 opportunities a month come through. So, I mean, and I would love for you guys to produce a report if you can get your hands around it, showing all of a sudden from a macro level view where all these new projects are going. So we all understand what the supply is going to look like. Because I think it's enough for us to try to figure out how deep the demand is. We know it's there, we know it's robust, but how deep is it? But then also the supply to ensure that we're in proper balance as we go through the development of this awesome product, which we all agree.
When does BFR maybe start getting into higher priced metro areas, higher priced markets? Or I know there are luxury BFR communities out there, but that's not the norm. Do you see it evolving that way at all?
We haven't seen that of materiality. It just doesn't seem like there's the land to support, that infill type more than just one or two houses, if you're talking the really higher end. And then, just kind of depends on geographically. I haven't seen one come across, or I should say, a parent level company that's doing this that says, we're going to focus on, the higher, and arguably, what does that mean? Of course, by geography. And those are also the people that we're seeing that are last to lose their jobs through this as well, that are buying the homes. And so that's a big unknown. It's an excellent question. And if someone knows the answer, I would love for them to reach out to me and tell me.
Yeah, it's still so far. I mean, there are a few kind of quote unquote luxury BFRs, but they're few and far between, and they tend to be, like you mentioned, those kind of infill areas. So it doesn't seem like there are the mechanism there for it to be a big part of BFR. And also, typically, they can get a little more for their money doing for sale or something like that, if it
Exactly.
in those higher price markets. Yeah. How about product? I mean, do you think about product for BFR at all? There's all the way from horizontal apartments, those really dense, small unit kind of BFR projects, up through very, very traditional single family. Do you have any bias or any sense of where the sector goes in terms of product?
I think the answer is no, I don't. I do think proper management of the property is what really creates the difference. Is it maintained externally and the units internally, to create the feel of whatever market you're going for, as long as you're hitting the right area? I think either one are equally as viable. I mean, we have a commercial real estate division within the bank, and my peer on that side and I can debate all day long the difference between is multifamily better, or the single family build to rent. I mean, I personally think people want a yard, especially if you can get the maintenance done at a monthly payment. Let's say if that's what you're looking at, you can afford. So between those two, I really don't have I can't say I'm super hot on one or the other. And then again, to your point, on the higher end, just don't have enough depth to really make a comment, and haven't seen it enough to make any sense of anything that I would say.
Yeah, and it starts bleeding over in terms of the demand pool. It starts bleeding into folks who are more likely to be in the for sale world at the higher end, I imagine.
Absolutely.
What more serious question now, Melissa? What's your favorite type of whiskey? And notice I didn't ask what your favorite type of booze was, because you're from Texas. So seriously, it has to be whiskey. And I was
Oh,
shocked to hear about Chardonnay, by the way. I was
it's
that
actually
was stunning.
it's called Chardonnay, not Chardonnay.
Oh, sorry, that's
But
my bad. My bad.
yeah. Chardonnay
Chardonnay
from the gas station. You California boys do it high dollar, but in Texas we can buy it at the gas station.
in a
I would
box.
say
I'm assuming in a
it's
just
actually, you can probably walk away with 16 ounces of cheap Chardonnay gas station for $5 or $6. So hence why all the California people are moving here. Immigration is huge. It's not just because of housing and job creation and a lack of taxes. It's our gas station Chardonnay. Make sure to tell John that, please. And
I
then
will, and
um,
we'll teach you guys. We'll teach you guys in Texas how to stop drinking it straight out of the spigot there, and how to open the bottle. We'll consider that kind of just a favor.
are you suggesting that the straw is a bad idea?
You know what? Actually, the sippy cup, maybe. The straw's fine.
The sippy cup does work well for no spillage.
That's true. That's true.
Whiskey's Pendleton. That's a cowgirl whiskey. Is Pendleton,
Okay.
and for any of your clients that are whiskey connoisseurs that haven't tried good old cowgirl Pendleton, I highly recommend it.
Is it a bourbon or is it I don't know whiskey. My friend David Jarvis, who you know there in Houston with us, he taught me that bourbon is a type of whiskey, which is confusing to me.
Yeah, I'm not a whiskey expert. Again, I could talk gas station Chardonnay, and actually can talk a little upper level California winery. But as far as
Okay.
the Pendleton, I know it is whiskey. When it's cold here, which is laughable to some folks, or when I travel where places that really is cold. We do have a large Canadian base that we finance. I mentioned we're nationwide and probably managed to offend them, so I should have added Canada and Australia we finance. But yes, I will on occasion have a little toddy, or if I develop a terrible cough, I do believe that works very well.
If there's a market downturn, does your choice of alcohol change? Like you go with the Boris Karloff daiquiri, orange juice, and jet fuel? Is that an option in those days?
I appreciate your deep thoughts. I'd rather get a second job and continue to drink what I drink. So if you're hiring, if it gets really tough, could you please let me know so I can continue to get my gas station Chardonnay and then on occasion my shot of Pendleton?
We will. We will for sure. Now I'm asking for a friend. I mean that literally too. Our friend Rick Palacios. How is riding a horse like investing in housing?
It's such a good one. How is riding a horse like investing in housing? You know,
Yes.
if you're good at it, most of the time you get it right and you make some good returns on it. However, when you get it wrong, it's disastrous and it becomes the equivalent like a dog lot, dog neighborhood. Next thing you know, especially in those areas that aren't zoned, right? You end up with something next to you don't want. And so when you miss in horses, you miss pretty hard, but you end up in the hospital. And although financially you may end up in the hospital in real estate, generally I haven't seen people end up there in the in the actual physical hospital.
So housing is less dangerous than horseback riding, but just as thrilling
Physically.
and keeps you on your toes. Yeah. Okay.
It's
Physically,
it's
yes. You're right. You're right.
typically, I think housing financially could be more. I don't know, man. It's another thing you could argue, just like build to rent. I do have horses for sale, and I'm more than happy to, for the first time probably ever, experience real financial success in the space. If anyone is interested.
You now, I mean, you've probably made some investments in the past that you weren't super happy with. Has there ever been just a investment that you'd look back on and said that was nuts? And please say Armadillo Farm, but go ahead.
I'm going to go with my marriages.
Okay,
I'm
that's
pretty
I guess
sure
okay, it's a type of
those have
investment.
been those have not worked out well for me investment wise, especially when you take into account the lack of prenups. So that would be number one. Um, Followed by horses. Haven't tried the Armadillo Farm, but this is a trip. So my business partner and I, Jocelyn, who we launched this gig, we decided that we were going to do a distressed asset fund. At the same time, we launched the gig in late 09, early 2010. And, we're bankers, so we have to have a lot of room for error. And so the first, is couple million we did with easy, and then it becomes like just it's fun money. And for those people who do it professionally, I mean, those are great times, right? Because your yield is huge. But then you realize when it's everybody starting to buy it up, and then you have that one bad decision, that hurts pretty good. Nothing like a divorce without a prenup, but it got us pretty good. When you're living just on a banker's salary and no more distressed asset fund return, it definitely is eye opening.
So you're gonna complain about living on a banker's salary. Okay, Melissa, if that's what you want to say, that's fine. Really, that'll cover really.
Why do you think I'm having to buy gas station Chardonnay? Okay.
I think that's taste more than the finances. That's just it's my gut. Um, Let's do qualitative. John Burns is like to occasionally he'll ask us to list qualitative indicators that maybe the market is a bit overheated. We're starting to hear some concern in some sectors that's happening. Things like, sales agents are driving Mercedes, high end Mercedes or something like that. Are you seeing anything like that? Do you ever think about those kind of indicators? Are you seeing any of those kinds of qualitative things?
I still have that poster up in my office that he
Do you really?
produced back when I do. When sales agent, buying Lamborghinis and,
Yeah.
people who make minimum wage are buying four houses.
Yep. Flipping them. Yeah.
But I think the difference is in this case, the supply is so limited, right? So you're not,
Yeah.
it's just such a different time. So you don't see quite that level, in the way the mortgage industry to some extent, arguably, corrected. And so I don't think we're seeing anywhere near the same concern that we saw back then. Again, our concern or my concern is, you have to have enough volume to feed the demand, number one, and can you get it on the ground and, get it pushed through the chain? And then two, are we going to look up and realize we stole demand from ourselves and then, have reduced volume pushing through? Because you have those two things. But what helps me sleep at night is the supply. I mean, it's like nothing that anyone I know has ever seen. And I have two people that work for me that have been in this industry almost, one's 40 years and one's 38 years, and no one's ever seen it. So, how do you answer that question? It's night and day. I would say if there is any overheating, it would just be simply in the upcoming supply of the single family for rent space, which sounds probably stupid considering all the articles we see saying it's undersupplied. And that is the case today. But again, we can't gauge what's coming on because it's smashed into the permitting in many cases with CRE.
That's a good point. I mean, it may be that single family built for rent in 10, 20 years, we'll look back and go, why wasn't it such a huge part of housing? It should have been long before 2010 or so, or 13, 14. Or it could be a temporary thing. I think it's long term is here to stay and here to stay in a big way. But you're right. We don't know that for certainty.
I agree it's here to stay. And I think it's going to be a material part of housing for the rest of our, foreseeable lives. It's just, are we going to oversupply it on accident because we can't count how much is coming? And that's, and again, you've got people who don't know the industry pouring into this space. And there's nothing more dangerous than that. Because you get a group of 5 investors and, they'll support it and kind of throw it together and there's not enough meat on the bone. Then they'll fire sell it. And then that, messes up everybody else who's trying to get a normal return. And I mean, that's the risk in it. But I do think it's going to be I've always believed in the space and will continue to do so. It's just, we have to ensure that people who do not have the ability to execute properly, price properly, and continue maintenance properly aren't enabled by banks to get product on the ground and mess the rest of us up.
And like you said a minute ago, a little while ago, that in the Great Recession kind of winnowed out those less serious actors in the for sale space, and maybe that might need to happen in the built for rent space as well.
Agreed. I mean, because the folks we see now that are running in the traditional space, I mean, are brilliant folks. I mean, our client base, I learn so much from every day. And, I really do, all kidding aside, credit them for teaching me and my leadership team how to run a through cycle successful franchise. And one of my favorite quotes, I'd like to share this, is you have to remember when you're running a business, you run it for the market as it is today and to succeed in profit in the market as it is today. You don't look at it as if you're in a down compressed market or a challenging time. You run your business to succeed in the market as it is today. Reinvention, continue to reinvent, be disciplined. Don't get over levered. Have cash somewhere under the mattress. Don't buy expensive wine from California. Get it from the gas station.
Okay. That last one, I think, is probably the least important since I'm from California. So, let's wrap up with a little more serious question. The housing cycle was kind of, for a very long time, the housing cycle was boring, right? It was kind of reliable, consistent. You had these sort of modest but pretty stable returns. These last two cycles, I'm going from 2008 to current, have been pretty wild rides. Do you see housing as more permanently kind of volatile sector, or have these last 2008 forward been a little more of an aberration?
Great question. I'm going to go with, and again, not going to bet anybody on this, but I don't think we're going to see the volatility that we had seen. I think there will be cycles, but given the diversity that we're seeing in the product, the sophistication of the operations, the, I guess, old school. I mean, when I started, a leverage of 4 to 5 times was normal. A net margin of 4% was a whopping success. And again, like I've been saying, since the recovery, you're seeing people run an average of 1.5 time leverage, and just net margins 8, 9, 10 above percent, and just war chesting liquidity, because I don't think any operator, even if they, which there were many that did, stayed profitable through the correction that even we financed, want to feel that much pressure again. So they're war chesting liquidity, and not stupid where they're just sitting in cash on the balance sheet. They're investing it in their own WIP. So, but it's just not the model it used to be. Bob the Builder, those days, we just don't see them like we did. It's become an industry that the level, again, of sophistication, private or public, or, small regional. It's just, you've got different players that are running to run businesses. And like any industry that has cycles, it just, to me, we didn't have the discipline, the quality of operators necessarily in the past. And I think that'll knock out some of the volatility. And again, I mean, I would love for anybody to call and debate that with me, because I'm always trying to learn and see things through a different lens, all kidding aside.
I would love to, but I actually kind of agree. I think also just we have to remember this wild rise these last kind of two cycles. It was a great recession, second only to the Great Depression. Then it was that kind of delayed recovery, and then it's a pandemic. That's those are kind of historical aberrations. So it does make sense that some of that volatility, right? Does that make sense?
Exactly. Absolutely.
Okay. Awesome. Well, Melissa, this has been this podcast has been a wild ride, as I knew it would be. Thank you so much for joining us.
My regards to you, your firm, John. And on a serious note, and this isn't some silly infomercial, and anyone would tell you within the industry, the analyst that we speak with, I mean, we rely on you guys. And again, I want to make it clear, no one asked me to say anything, but I do mean this. I mean, you guys have been amazing in helping us steer. Our record of 0 losses is attributable to you guys, your guidance, John. I mean, through the pandemic, we almost spoke every single day on how to steer, how to turn, how to navigate and reinvent. So, you gave me a lot of runway to say, great things I think about our success, but I want to push it back to you guys. And even though John and I easily can talk ourselves into a Great Depression over what's going to happen sometimes, he is my mentor. And for that, I'm thankful.
Well, thank you. Those are very kind words. And thank you for John as well. Appreciate that.
All right. Send gas station Chardonnay.
I will. Thank you so much. Melissa Abel from Texas Capital Bank. This has been New Home Insights podcast with Dean Worley. Thank you so much for listening.